Hey everyone, and welcome back. Today we're going to dig into a really interesting investment option, especially if you're thinking about your short-term goals. It's called the Hdfc Income Plus Arbitrage Omni Fund of Fund. Yeah, it's a mouthful, but don't worry, we're going to break down exactly what all that means.
So, we've all been there, right? You've got some cash set aside, maybe for a goal that's about a year away. You want it to be safe, for sure, but you also kind of wish you could earn a little more than it does just sitting in a savings account. And if you're being really smart about it, you want to be tax efficient. Finding that perfect balance can be tough.
All right, so here's the game plan for today. We're going to start with the basics of what this new fund is all about. Then we'll demystify some of that jargon, terms like arbitrage and fund of funds. After that, we get to the good stuff, the risk, the potential returns, and the tax benefits. And finally, we'll help you figure out if this is something that could actually fit into your own financial plan.
So first up, what exactly is this thing? Well, it's being presented as a potential answer to that short-term money problem we just talked about. Think of it as a hybrid, something that tries to blend some of the best features from both the debt and the equity worlds.
Okay, let's look at the official definition. The most important words here are fund of funds. So instead of thinking about a fund that buys individual stocks or bonds, picture a big basket that holds other, smaller baskets. This fund invests in a collection of other mutual funds, which is a fantastic way to get diversified right from the get-go.
And if you look at its mission statement, right from the source, its goal is pretty clear: to generate income or grow your capital. And the way it plans to do that is by investing in two main types of funds: arbitrage funds and debt funds.
All right, that official language can be a bit heavy. So let's really unpack the two concepts that make this whole thing tick: arbitrage and fund of funds. We're going to turn that jargon into plain English.
First, let's tackle arbitrage. It sounds super complex, but the idea behind it is incredibly simple. It's all about taking advantage of tiny temporary price differences for the exact same thing in two different markets.
Now, this is where it gets cool. Here's a simple way to think about it. Imagine a fund manager sees a stock selling for 100 rupees right now in the cash market. At the exact same moment, they see a futures contract to sell that same stock for 101 rupees a month from now. They can buy at 100 and sell at 101 simultaneously, aiming to lock in that 1 rupee profit no matter what the market does. The whole strategy is about making thousands of these tiny, low-risk trades.
And the second piece of the puzzle is that it's a fund of funds. So remember, you're not just betting on one manager's arbitrage strategy. You're investing in a whole portfolio of different arbitrage and debt funds, all chosen by the fund manager. It's diversification on top of diversification.
So, if we peek under the hood, we can see the fund plan is to invest almost all of its money, we're talking 95 to 100%, into these other funds. The fund manager's job is to shift the money between various arbitrage funds and debt funds depending on where they see the best opportunities at any given time. Okay, so we've covered the how, but the real question is, why should you care? How does all this translate into something that actually matters for your money? Well, let's talk about the big three: risk, returns, and, of course, taxes. Now, the first thing you'll see is the official riskometer, and it labels this fund as high risk. And you might be thinking, hold on, you just said this was a low-risk strategy. And that's a fair question. Here's the deal. Any fund that has exposure to the equity market, even in a hedged way like arbitrage, has to get this regulatory tag. It just means it's not risk-free like a bank deposit. But the strategy itself is designed to be very low volatility and avoid those big market swings. So let's be crystal clear about what this fund is trying to achieve. A normal equity fund is aiming for a home run. It wants big growth when stock prices go up. An arbitrage fund, on the other hand, is just trying to get on base consistently. It's looking for small, steady gains from those price differences. The returns are meant to be modest, but also much more stable. And now for what might be the main event for a lot of people: taxes. This is where this type of fund can really shine. Because it's structured the way it is, it gets taxed like an equity fund. So if you hold it for over 2 years, your gains could be taxed at around 12.5%. Now compare that to a fixed deposit, where your earnings are just added to your income and could be taxed at your slab rate, which might be over 30%. That potential tax saving is a huge part of the appeal here. This table really lays it all out. When you put it side by side with a typical debt fund or an FD, the one thing that jumps out is the taxation. Yes, the returns are linked to the market, but that potential for equity tax treatment is the key difference, especially when you're thinking about parking your money for the short or medium term.
All right, we have covered the what, the how, and the why. So now let's bring it all home and tackle the most important question of all. Is this fund actually a good fit for you and your goals?
So who is this built for?
Well, the official documents say it's for investors looking for income or growth from a mix of these different schemes. And while it says long-term, this strategy is very popular for people looking to park funds for shorter timeframes, say anywhere from 6 to 12 months or a bit longer, where the goal is to get better post-tax returns than you would from more traditional options.
And for anyone who's thinking this might be right for them, here are the crucial details on the new fund offer, or NFO. It opens for investment on February 27, 2026, and it will close on March 11, 2026. During that window, you can buy units at the initial price of 10 rupees each.
So we'll leave you with this question to think about. If you're searching for a tax-efficient home for your money for the next year or two, and you're okay with returns that are linked to the market, does a fund like this check the right boxes for your portfolio?
And finally, of course, the important disclaimer. Please remember, this is all for educational purposes. It is not financial advice. Every investment comes with risk, and it's always a good idea to chat with your financial advisor to see if any product, including this one, is the right fit for your personal situation. Thanks for tuning in.